You have to understand the central tenets of price delivery. Where's price going? How is it delivering right now? Was there any manipulation recently? Was there any stops rated while you're expecting it to go higher? Did it trade down into an inefficiency while you were expecting it to trade higher at a time of day when you expect it to run? When does the market usually have a spooling event? That means where it starts to run in one direction. It doesn't need to be fast. It just means it starts to go into a specific buy or sell program. That's not a buy and sell model. Knowing that ebb and flow, how it does it. When there's an established bias or an order flow or a sell program that's entered into the marketplace and it's been going lower. When it moves against that, all you're doing is building a short-term premium. Starts trading up into the previous day's range if it went down. And as long as it doesn't go crossed half of that previous day's range, the highest probability short is going to exist in the lower half of the previous day's range. And if it can't get 1/4 into it from its low, and it starts giving you a breakdown in market structure on lower time frames, you have all of the hand that needs to be shown to you at the poker table that this is what the market's about to do. It's going in to price in a short-term premium. Then you wait for a shift in market structure, which is not a break in structure. It's a shift in market structure. It's a continuation of the existing narrative and or buy or sell program. That's it. That's the definition. I want an ICT dictionary. Take fucking notes. But if you're just listening to it and eating fucking Cheetos, it's not going to work for you. You're fearful that this isn't going to work. Fear is the lack of journaled case studies. And that way you see how many times it works. How many times did it fail? How many times did it go into a certain measure of drawdown? How many handles did it go against you before it started moving in your favor? How long did it take from your trade entry and then when it got to your objective, whatever some liquidity would be or inefficiency it would be trading to? Your target is always going to be the opposing inefficiency. That means a fair value gap below if you're short, or you're looking for a low or relative equal lows. Stop listening to these fucking asshats out there saying that I'm overcomplicating. They're out there waiting for a fucking random time when an indicator is supposed to say something. I know exactly what the fuck I'm doing by the fucking minute. Every single fucking trading day, I know what minute I'm going to fucking trade. I know what time my fucking targets are going to get hit. Fear is easily conquered. Easily conquered. Once you go through the process of collecting the resources and case studies, and what you're doing is you're training your brain by retention, doing it over and over and over again, as if you were there. And because you're making it meaningful to you, it's like writing a love letter to your future self. And this is a very integral part to learning how to do this. You have to condition yourself. Stop forcing it. Stop rushing it. You condition yourself to find the profile in the marketplace. For some of you, it might be as simple as I want to do a classic ICT buy day where you're waiting for the opening. You want to wait for a Judas swing to drop down, maybe going into take sell side liquidity out on a lower time frame or trade into a buy side and balance, sell side efficiency, fair value gap. And then you're buying that with the expectation you're going to hold it for the entire range. Things occur at a specific time of the day, specific days of the fucking week. All these things are repeating phenomenon. They're not random. They are set on a schedule. They're going to fucking happen. It doesn't matter how many fucking people are buying it or selling it on Reddit. They're not going to make the market do any fucking thing. They're going to fall victim. AMC, perfect fucking example. This is their game. You have to play by the fucking rules. And I'm showing you what the rules are. I can make you a profitable trader. I can make you a fucking millionaire if you just listen to me. That's on you. But you have to know how you're going to do it. That means how you are going to engage price. Once you understand what you're going to do in terms of how, what is it you're waiting for in price? You have to have an understanding of narrative. What makes this market likely to behave a certain way? If the market is expected to go lower, you've been anticipating the market going lower on the weekly chart. There's something down there, 150 handles below where we're at the close on Friday. So your analysis on the weekend before the market opens up, you're anticipating that it's likely to draw down 150 handles. Okay, that sets the tone for your bias going into the week. Then you want to see how we open on Sunday. On Monday morning, see how we traded overnight, what we did in the London session, and then how we primed for Monday's opening. What you would expect to see is a rally higher that's rejected, a clear and obvious shift in market structure with a displacement leg that has a fair value gap. Easy peasy lemon squeezy. But you don't want that. You want fucking laser fucking lights and fucking shit flying across your fucking charts and all that kind of stuff. Because it's entertainment then. Fuck entertainment. I'm entertaining myself with the fucking money I'm making. Okay. I'm at war right now. Everybody that gets in there, it's on the other side of my trade. It's falling on my sword. How is this going to hurt the average retail trader? That's the most succinct, easiest, straightforward, no fucking punches held explanation of narrative. Because that's exactly what it's doing. It's going to form between 10 o'clock and 11 every fucking day. It's going to form between 3 o'clock and 4 o'clock every single day. It's going to form between 2 o'clock and 3 o'clock every fucking day. It's going to form between 3 o'clock and 4 o'clock in the morning every single day. Which one can you do? I can't do any of them. ICT. I need to be able to trade in Asia. Well, then you have to be a long-term position trader. What do you mean by that? When you're bullish, when the market opens up and it's in Asia and you're expecting it to go higher for a series of days, if you get some kind of a Judas swing in Asia, then a shift in market structure that's bullish, first fair value gap you get, buy it, stop below the low, let it go. There it is, it's done. You'll know when it was likely to form. You know that you'll be in front of the charts when it's ready to deliver it. You'll be anticipating it. And when it steps its ass in your crosshairs, you will gently hug the trigger.